Hello and welcome to All Things Money. I'm your host, David Blain. During this segment, we're going to wrap up our discussion about tax rates in the U.S., kind of a fascinating history. From 1913, the income tax in the U.S. turns 100 next year, and I thought it would be kind of fun to look at some of the tax rates. So we see that what was initially designed to target a few wealthy people at the top has obviously expanded well beyond that at this point to encompass a number of Americans, about 50% of Americans. So we see that as we left the last segment, if you missed the last segment, archives posted on the website, www.dlblain.com. As we were discussing there, as we left the 80s, we saw the top tax bracket at 70%. On lower income folks, it was around 14%. Then we entered kind of the modern era. Ronald Reagan came in and lowered those tax rates, and then under Bill Clinton, we had what most people kind of remember. We had the lowest bracket as the 15%, the highest tax bracket of 39.6%. So yes, historically, that was somewhat lower than 70, 80%. The one thing that you can't pick up from this, you really have to study the issue, is the definition of income has changed over the years as well. And so during some years it was, net earned income, like employment, job income was taxed differently than other types of income. And so some of those nuances of the tax code, and believe me, there are a lot of them, you can't pick up just from looking at the marginal rates. But still, it's illustrated to see kind of how the rates flow. And so then under President Bush, we saw the rates lowered to the lowest rate at 10%, and the highest rate at 35%. The other thing you see throughout time is the lack of a coherent policy. I mean, it's just all over the place. The lowest rates going up, down, the amount of income that it's taxed on. It's just quite fascinating to look at. Okay, some of the things that, as we look, there's nobody out there, liberal, conservative, Democrat, Republican, that doesn't think that taxes are going to go up in the future. Some people are fighting hard to prevent that. We talked last week about some of the new taxes in the Obamacare bill, tons and tons of new taxes, the new Medicare tax, among other things. I wanted to point out today a couple of things that you can do immediately to help yourself. These are things that you don't have to be wealthy to do. Number one would be consider, if you do invest and have built up capital gains, consider taking some of those gains off the table. That this, especially if you're in the 0% capital gains bracket now, that bracket is probably not going to last forever. And so this year, typically at the end of the year, we see a lot of tax loss selling. This year, I would anticipate seeing a lot of tax gain selling in anticipation of rising rates. Muni bonds. Typically, we're not that enthusiastic about muni bonds. Their rates, you have to really look at the tax bracket you're in to determine whether they're a good deal or not. If rates go up as we think they are next year, it just increases the case for muni bonds being worthy of looking at. One of the problems with muni bonds, especially if you're in the if you're buying funds or exchange traded funds of muni bonds, is they typically have an overweighting to the big tax states like California, Illinois, and New York. Like, you're not going to see a lot of Florida municipal bonds. And why is that? Well, Florida, there's no income tax, so there's no benefit to you buying Florida muni bonds in that state for state tax purposes. Now, there are some Florida muni bonds, don't get me wrong, but the majority of the bonds, when you look at these national muni bond funds and things like that, are in California, Illinois, and New York. Well, those also happen to be three of the states that are on the shakiest financial ground. We see bankruptcies in California, some of the cities, Stockton, California recently. So there is some risk involved in muni bonds, but the muni bond default rate, despite the spike since the recession, still remains fairly low. Buying a home. I know real estate has really been sort of poor investment recently, and we tell people all the time, a home is a place to live. A home is not an investment, okay? So don't go cash all your money out of your investments and put it into a home. However, if you need a place to live, which most people do, and you're looking at renting versus buying a home, you need to be advantage of, be aware of the advantages of real estate. One of the big ones is the first $250,000 or $500,000 if you're married of capital gains when you sell a home is tax-free. I mean, I know some people that, especially common in the home builders, that they'll go and build a home because they can build it for a lot less than they can buy one. So they'll build a home, they'll live in it for 2 years, then they'll sell it, pocket all the gain is tax-free. Now, the wives of the home builders don't necessarily like this moving every 2 or 3 year strategy, but it is a tremendous way to accumulate tax-free gains. There's nothing wrong with anyone doing it. You don't have to be a home builder. You just have to be really smart when you buy it, especially if you're paying a commission when you sell it. I mean, there's 6-7% with fees closer to 10% off the price. So you have to make sure that you're actually making some money when you're doing it. But anyway, it is there are some decent shelters with buying a home. The taxes and interest are still tax deductible at this point. Maxing out the Roth IRA, and this goes hand in hand with looking at your 401k, looking and seeing if you have a Roth 401k option. For the highest of taxpayers, I think, taking, if you're still years and years away from retirement, taking the current deduction still makes a lot of sense. But if you're getting close to retirement and, you're putting money into a deductible 401k, you may want to look at it, because I think you'll be surprised when you retire where your income may be. We're seeing a lot of people where the Roth 401k is an advantage. And the same thing with, if you qualify for a regular Roth, you definitely want to try to scrape together that $5,000 a person and get it into a Roth. It is one of the best tax breaks still out there that is available for people. The tax-sheltered 529 plans as well for saving for college are a decent tax shelter for your average Americans. Well, anyway, there's a couple of tax tips to help you in this era of what we think will be rising taxes. Well, that's the end of our show for today. I hope you'll come again and join us again next week. So for All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.